Okay, today we're going to be working on 12-1B, entries in balance sheet for a partnership. On April 1st, Whitney Lang and Eli Capri form a partnership. Lang agrees to invest $18,000 cash in merchandise inventory valued at $50,000. Capri invests certain business assets at valuations agreed upon, transfers business liabilities, and contributes sufficient cash to bring his total capital to $120,000. Details regarding the book values of the business assets and liabilities and the agreed valuations follow, and then we have this chart here. Okay? The partnership agreement includes the following provisions regarding the division of net income, and then it tells us about that. Under our instructions, number 1, journalize the entries to record the investments of Lang and Capri in the partnership accounts. And number 2, prepare a balance sheet as of April 1st and the date of formation of the partnership of Lang and Capri. And that's where we're going to stop. We're just going to do steps 1 and 2. Okay? So step 1, journalize the entries to record the investments of Lang and Capri. First thing we're going to do is we're going to take all of this information up here and we're going to put it in list form so that it's easier to follow. So first partner we have is Lang. And you can use a piece of scrap paper. I'm actually putting it at the bottom of my working paper. And Lang invested $18,000 in cash. And it also said there was $50,000 of merchandise inventory. Okay. And then it states that Capri invests certain business assets, transfers business liabilities, and contributes sufficient cash to bring his capital to $120,000. Okay, so over here we have Capri, and he has $120,000 in capital. Okay, it also tells us everything that Capri is investing, so from accounts receivable down to notes payable, and these are the numbers on this side that we're going to use, this agreed upon balance. Okay, what he has in his ledger is great, but this is what's actually being invested into his business. So these are the numbers we're going to use. So we're going to pull all of these out of your book and put them onto our working paper here. I'm actually going to kind of draw a dotted line here so that we can keep these separate. So we had $43,400 of accounts receivable. He had $3,500 of an allowance for doubtful accounts. $28,900 of merchandise inventory, $63,400 of equipment, $23,400 of accounts payable, and $15,000 of notes payable. Okay. So we need to find out, it says that he invested sufficient cash, but none of these are cash. So we need to calculate that amount. Now, accounts receivable is an asset, so that's a positive to our business. The allowance for doubtful accounts is a contra asset, so that one we need to subtract. Merchandise inventory is an asset, equipment's an asset. Accounts payable is a liability, something we owe, so we're going to subtract that. Notes payable is a liability, something we owe, so we're going to subtract that. Okay, whoops. So we're going to add these numbers up, subtracting the ones that we put subtraction signs by, and we get $93,800. Okay, now I'm going to put another dotted line here. It's told us that his actual capital was $120,000. So we're going to take the $120,000 minus the $93,800, and we're going to get $26,200. And this tells us our cash amount. Okay, this was our capital. So this is what we're going to use for his cash. Okay. So journalize the entries to record their investments. So we're going to come back up here to our journal. Our date is April 1st. And you can just put whatever the current year is. Our first person that invested was Lang. And we're going to list our debits first. And since we're receiving cash, we're going to debit it. So a debit to cash for $18,000. The other thing that Lang invested was merchandise inventory, which is also an asset. So we're going to debit that as well for $50,000. And then we're going to list our capital. So Lang's first name was Whitney. And we know to increase capital, we need to credit it. That's one thing we learned in Accounting 1. So 18 plus 50 gives us 68,000. Okay. So now our next investor, so we're going to do another transaction, so we need another date. Again, we're going to list our debits first, which would be our assets, so cash. And I'm going to come down here. Cash, we had $26,200. And I'm going to check mark that so I know that I got it, so that I don't lose anything in the process here. Okay. Accounts receivable was $43,400. Again, check marking that so I don't lose it. We're going to do all of our plus signs first here. Merchandise inventory was $28,900. And equipment was $63,400. Okay, now our credits. Our first one was allowance for doubtful accounts, so we're going to indent a little bit for our credits. And then accounts payable for $23,400. And then notes payable for $15,000. And then that capital account, that person name is Eli Capri. Was a credit for $120,000. Okay. So those are your journal entries. That's step 1. Step 2 says prepare a balance sheet as of April 1st. Okay. So we don't technically have a company name for this balance sheet, so we're just going to put Lang and Capri. Oh my goodness, my pencil keeps falling apart. A balance sheet is a snapshot in time, and our time is April 1st of the current year. Okay. So our balance sheet, we're going to start with our assets, and specifically our current assets. We know that current assets, as a review, is anything that can be turned into cash within a year. Okay. So obviously cash is the first one. If we look at the entries we just did, we had $18,000 of cash here and $26,200 here. So I'm going to do this in the margins over here. We had $18,000, $26,200, and if we add them together, we get $44,200. Okay, so this becomes our cash amount. We're going to stick this number in the middle because while it's not our final number, we don't have to do anything with it. Okay. Our next one that's very liquid is accounts receivable. If we look at our journal entries, we have accounts receivable was $43,400. We're going to put this one in the first column because we do have to do some math with this number. Excuse me. We had a doubtful account, so we need to subtract that. So we're going to put less the allowance for doubtful accounts. And again, if we look back at our journal, it says it was $3,500. We're going to put a single line under that. Since it says less, we're going to subtract these two numbers and put the answer right next to that $3,500, and we get $39,900. Okay. Our last current asset is merchandise inventory. Again, looking at our journal, our merchandise inventory from Lang was $50,000. From Capri, it was $28,900. So we're going to add those two numbers together. And we get $78,900. So that number is going to go over here in the middle. We look at our journal, we've used cash, merchandise inventory. We're looking for assets now. Cash, accounts receivable, merchandise inventory. Equipment is the only asset we haven't used, but that's going to be put under property, plant, and equipment. Okay, so we can go ahead and total these current assets up. We're going to put a single line here. I'm going to add these three numbers together, and I get $163,000. And I'm going to label that total current assets. Okay, my next section is going to be called property, plant, and equipment. Oops. The only one we have is equipment. So since we only have one, we don't have to do any math to it. We're going to shove that number all the way over to the right. And that number is $63,400. That's the end of our assets. So we're going to take these two numbers and add them together. So put a single line under here, add those two together, and we get $226,400. And that label is going to say total assets. Now at the top, we had current assets and total current assets. Then we had property, plant, and equipment. Since there's only one, we don't need a line that says total property, plant, and equipment just to put the number in there twice. Okay, so we're just going to total assets on that one. So assets equals liabilities plus owner's equity. So the next section we're going to go to is liabilities. So center the word liabilities. We don't skip any lines. We don't want anybody to be able to add anything while we're working or after we're done working. Okay. Just like the assets section, we're going to start with current assets. Oh, I lied. We're going to start with current liabilities. This is why we work in pencil. There we go, and a colon. Our first current liability is accounts payable. Again, I'm getting all of this off of our journal over here. So accounts payable was $23,400. We don't have anything else to do with this number, so we're going to put it in the middle. And our notes payable can be a current liability or it can be a long-term liability. It all depends on when it's going to be paid. In our textbook, it tells us that notes payable was current. Okay, so we're going to list that under our current liabilities. That means that this amount is going to be paid off within the year. And that amount was $15,000. Okay, those are all of our liabilities, so we're going to put a line under this. Add those two numbers together and we get $38,400. And that, whoops, sorry about that. That is our total liabilities. Now our next section, when we did sole proprietorships, we always called it owner's equity. Now that we're working with partnerships, we're going to call it partner's equity. So centering those words, as best you can. We're going to list our first partner was Whitney Lang. Capital. And looking at our journal, Whitney Lang's capital was $68,000. So no extra math to do with this number, so we're going to stick it in the middle. Our next partner was Eli Capri. And his capital was $120,000. Those are our only partners. If we had a third, we would list them. So we're going to go ahead and double underline that. Add those two numbers together and stick it over here on the right. 188. Oh, this pencil. And we're going to label that total partners equity. Okay. Our last line is going to say total liabilities and partners equity. I didn't realize I was that close. Since I had to put it on two lines, our number is going to go on the second line. So I'm going to put a single line under this 188. And I'm going to add the 188 and the 38,400. And I get $226,400. So again, that's our total liability and partners equity. Now our assets, total assets was $226,400, and assets equals liabilities plus owner's equity, which was $226,400. So our balance sheet balances. Since it balances, we can tell by double underlining it, the person who's reading it, we can say, yep, it balances, we checked it, it's correct. Okay, $226,400. Okay. That's the end of problem 12-1.